The idea what we worked here on is we looked at of the IPD indices about the Nordics. And when you look at the Nordics, actually, normally the people talk about the Nordics as one region. Everybody says we have an allocation to the Nordics. But at the end, you have an allocation to 4 currencies. And that is something that's, from my point of view, often overlooked. You have the Swedish crown, the Danish crown, the Norwegian crown, and the euro. So that is something the most investors don't recognize. You still can say, yes, you have a Danish crown, but it's linked to the euro, so don't care about it. Okay, that's fine. But what you really figure out when we looked at the data is that it's much more about the Nordics than simply saying it's one investment region. You still have to account for the currency, and the currency effects can be very substantial, what I would show you in a couple of minutes, actually. When looking at the Nordics, that's a little bit of the background of the central bank interest rates there. What on the first step you already see is that the central banks react a little differently. Although the underlying fundamental pattern is quite similar, the Norges Bank and the Sveriges Riksbank, they have a little bit of a different raising and lowering interest rate pattern than the European Central Bank or the Bank of England or the Fed. So that should at least have some effects on the overall currency movements and therefore also on the return side of the investors, if he's unhedged. On the same time, if you look at the interest rate side, that is only the interest rates for the Nordic countries, so for the let's say currencies. You see that at least on the short end there is a difference between Copenhagen and Europe and the other 2 Nordic countries, Norway and Sweden. So that has some effects on currency movements if the interest rates do not move in line in their respective regions. So what is our overall view on the Nordics? As we expanded in the Nordics quite heavily in the last 2 years, that is a little bit that we say the Nordics, it's much more than the 4 capital cities. And I think that's more and more what the investors realize when they look at the markets. But especially if you go outside these markets, the question is what type of returns can you expect and how should you operate there? So that is something I will leave to the panel discussion for the end. So what I want to come to now is about the currency effects. If you look at the exchange rate movements, that's a European or a Eurozone perspective. What you see at first glance, okay, you can ignore the Danish crown given to the exchange rate mechanism too. It's linked to the euro, and yes, theoretically they can still break down the link and say we do our own currency again, but actually nobody's really expecting that. If you look at the Norwegian and the Swedish crown, what you see is they tend to move in a similar pattern on the ground, but in detail, the movements are sometimes very different from each other. And when you invested in a country and you're unhedged invested, what a lot of investors are doing, these can have substantial effects on your allocations and on your return side. So what exactly does currency risk mean? And I just started with a little bit of a quiz this morning. Maybe it's too early for asking you a question, but here you have the 3 sectors: office, residential, and retail. And these are, let's say, 3 markets: one yellow, one red, one gray market. So the question is, about which market are we talking here? Does anybody know which market we are talking about, or which markets do the respective lines represent? These are total return figures for different markets. And the interesting thing is when you look at it, it's only about Denmark. These are the total return figures for Danish property in US dollar, British pound, and euros. And that is what currency risk that really means if you go for these countries. That's what you have to take into account if you go unhedged. And that's what the assumption is behind these figures. That's just like IPD converts these total return figures due to the currency movement during the year. And what you see is that it's not simply a shift effect if you have a euro or a US dollar or British pound return. Even the pattern is not really similar in the different currencies. And what our question then was, what is the effect on portfolio allocation if you take this into account? So we took a little bit of a step backwards, saying if we look backwards on the data and try to do a little bit of optimization and analyzing of the data, what would have been the effect for optimal allocations, for Sharpe ratios and all these kind of nice statistical numbers that the investors are looking at when you work on the Nordic market. So if you start just with the total returns, historical mean total returns, what you see is that the gray line is the local currency return, the red line is the euro. That is quite similar, something that you would expect because Finland has the euro, the Danish crown is linked to the euro. So at least these returns seem to be very similar. On the other hand, if you look at US dollar and British pound, yes, the returns are higher, but that's due to currency fluctuation, not the underlying fundamentals, and also they seem to be very similar. So that will be an argument against what I said before, that there's more about currencies that just similar, I would say, a shift effect. So from the mean total return side, it just looks as if currency has simply a shift effect. But if you look at volatility, the picture gets a little more messy. You realize that currency is much more about volatility in the returns. And that is what the investor increasingly figure out when they go unhedged for the markets. And if you talk to investors, a lot of investors are telling you, we go for property investments, we don't care about the currency. We might have an overlay on currency hedging over all our investments, might it be property, stocks, bonds, or whatever. But normally in the pure real estate investments, you're not accounting for hedging costs. And all the analysis we've done here is also without hedging costs. So if an investor is implicitly hedged by an asset liability management, he can still go for the local currency optimization. So what you realize is, although mean total returns would argue for a simple shift effect of currencies, volatility tells you a complete different picture, that there's more about the currency than a pure shift effect. So next step was we calculated a little bit of Sharpe ratios. That's a typical way to see how much return do I get for a unit of risk. And when you look at these, you very much realize that it's a very different picture depending on the currencies you're looking at. If you're being a residential player for a long while, with now more than 50% also in commercial, it just might start with the residential side, and you see if you're a Eurozone or local investor, you get the most out of Finland in the residential side, given that the Sharpe ratios are very high in these sectors. So the return you can achieve there, you can achieve with a very low risk side. If you go for retail, you say in Denmark, if you look as a Eurozone investor, Denmark retail and Finland retail might be the best options. If you're a British pound investor, you might more look to Norway and Sweden as the best retail investment location. So therefore you realize already, depending on the currency background you're having, and just simply looking at these statistical numbers, it's very important to really know not to understand the market you're investing in, because therefore you have the nice guys that are sitting on the panel later on to tell you, we understand the market and you can ask us for help. But you also have to understand out of which currency environment are you operating to really make the best out of your investment decisions. So next step, we try to figure out in the cluster analysis a little bit which markets are similar. So if you add to a portfolio, what might be sensible? So what you figure out, you're looking at Denmark and Finland. The office and retail markets in Denmark and Finland seem to behave very similar. No matter which currency you're looking at, they seem to behave very similar. What does it mean for an investor? Actually, it does mean if you're already invested in Danish offices, it might not be a good idea to go for Finnish offices. It might be a better idea if you go for Swedish or Norwegian offices, because therefore you can achieve greater diversification in your portfolio. So that is also a point you have to take into account. At the same time, we skip Norwegian residential because IPD simply doesn't provide returns on it. And the other reason is there is not really a big established residential market currently in Norway. On the other side, if you go for retail, for instance, Denmark and Finland, it's the same picture again. But therefore, you have Sweden and Norway are behaving quite independent from each other. So therefore, if you're already invested in Danish retail, you can go for Swedish retail and for Norwegian retail. You still add diversification no matter which sector you're going. Even if you go for both sectors, you add diversification to your portfolio. So if you work on all these data and look at it from the efficient frontier analysis, what we did then is we tried to let's say, calculate the efficient frontiers for the different currencies. And here's what you see when you look at the different currencies. You see that the efficient frontiers from the different currency perspectives are quite substantially different. And that is one of the things that you have to take into account. Yes, you get a higher expected total return in US dollars, but you have to pay for that with a higher expected risk, expected volatility in your returns. The same holds a little bit for the British pound, although in pounds the return is substantially higher, the risk is not so much increased. Local currency and euro, they are quite similar. Only if you go for the higher return or higher volatility end of the efficient frontier, you get substantial differences. And that has mainly to do with the fact that at least two currencies have virtually the euro. So the next point for us was, is there an overall effect on the allocation in the portfolios of the investors? If we just look at the mean volatility portfolio, that's the lower dot down there, for all four scenarios, do you have a different sector composition from the investor side that would have been optimal based on these historical data? And really it is. If you just look at being a Eurozone investor, your optimal allocation would have been Finnish offices, Finnish residential, and some Danish retail. If you're being a US dollar investor, your optimal allocation would have been 100% Finnish residential. Being a British pound investor, your optimal allocation would have been Norwegian offices, Danish residential, Finnish residential, and Swedish residential. So just simply doing this calculation, we figured out that it's much more about the currencies that normally, when you talk to investors, that they really realize. It's not only about us understanding the market, it's also about understanding what currency environment are you coming from and what drives the currency movements in these markets. And I think that is something the investors are not talking very much about it, because normally they tell you, no, we just go unhedged, we go for pure property exposure. But they get something very different because due to the currency effects that are overlaying these underlying property performance.